Good evening and welcome to this special Option Pit webinar. I am Mark Sebastian. So let's talk about what we're going to do today. All right, we're going to talk about options for stock traders. All right, and I'm going to be using LivevolX for Lightspeed. Reminder, materials presented from Option Pit are for informational and educational purposes only. We do not offer investment, legal, or tax advice of any kind. All right, nothing that you're seeing is legal advice. All right. We're not responsible for anything that you do that's stupid. And to the extent that you make use of the concepts and materials, you are solely responsible. So if we talk about something and you go do it, use money, it is your fault, not ours. That is what this is saying. We are here to educate. We are not giving advice. This is me, that handsome devil right there, Mark Salvo Sebastian I. And I was a floor trader for about a decade. And after I left the floor, I started Option Pit. And we are an education and consulting firm. We deal with retail traders, teaching them how professional traders trade. And we deal in the institutional space where we will work with advisors and hedge funds and money managers and mutual funds, and we'll stress test their strategies, help them improve their strategies, and more often than not, help them implement strategies. That's our general approach to managing all of this stuff. All right, so let's talk about the problem with stocks. All right, stocks are great. Here's the problem. Trading stocks is margin intensive. Reg T, even with Reg T, the margin is extremely expensive. Investing in stocks ties up lots of capital. The market can lead stocks one way or the other, whether you're right or wrong. You know, if you bought a really good stock in August, the middle of August, you probably are down money no matter how good that stock is, because the whole market took you down. And it can be hard to tell which way the stock market is going to go throughout the day. Right? That can make day trading difficult. So here's what you're going to learn. How options and stock are related, replacing stock in day trading, replacing stock in investing strategies, and a few indicators that we use in analyzing SPX and other trades. So I'm going to give you about 3 indicators I use. One is for day trading, and two is for swing trading. All right, stocks and options. All right, options are derivative of stocks. This means that for an option price to move, generally speaking, the underlying price must move. How well one instrument moves with another is called correlation. All right, correlation. So, you know, people will talk about the S&P and the VIX, right? The S&P 500 and the VIX has a negative 0.8 correlation. The S&P 500 and the SPY have a correlation of about 1. All right. Then there's, names like, the biotech index that has almost no correlation to the S&P. So correlations are how well different indexes move with and against each other. All right. So a short S&P 500 future correlates at -1. A long S&P 500 future correlates at 1. That's simple. All right, for option traders, how well the option correlates to its underlying is called delta. All right, that is delta. Thus, options can have a delta of between -1 and 1. All right, options that have a positive delta will move with the underlying. Options that have a negative delta will move opposite of the underlying. So if I have a positive delta of 0.5 and the underlying instrument moves up $1, my option should make about 50 cents. If the underlying drops $1, the option should lose about 50 cents. If it has a negative delta, flip those around. So here's an example. All right, this is TLT. This was taken a while back when TLT was trading around 126. But you can see the different deltas. So the 123 calls at this time had a delta of about 80. The 129 calls had a delta of about 21. So if I owned a 123 call that was worth about $3.30 and TLT rallied $1, that option should be worth about $4.10. The Januaries, the 29s, 21 delta, option worth 47 cents. If the option moves up $1, or the underlying moves up $1, that option should be worth about 68 cents. All right. So there you have it, right? The TLT Jan 123 calls have that delta of 80. If the TLT moves up by $1, they'll make $80 per contract, 80 cents in the option price. If TLT falls $1, the 123 calls will lose 80 bucks. All right. All calls have a positive correlation to the underlying. So calls, all right, correlate positively. Means they move with the underlying. All right, now let's look at a put. This is the TLT Jan 127 put. It has a 61 delta. It's worth about $2.04. 61 delta. So now let's look at what it does. The TLT Jan 127 puts have a delta of -61. Thus, for every dollar TLT rallies, the Jan 127 puts will lose $61, 0.61 in the option price. For every dollar TLT falls, the 127 puts make $61. All puts have a negative correlation to the underlying. Puts have negative deltas. All right. Now, don't forget, a negative times a negative makes a positive, and a negative times a positive makes a negative. So if I sell a call, that's a negative times a positive, that makes the delta negative. If I sell a put, that's a negative times a negative, making the delta positive. That's basic multiplication. Just remember that when you're trading. All right, so minimum overnight Reg T margin. So that's not even a cash account. So I'm actually margining your account here. So minimum overnight Reg T margin on a stock is 2 to 1. All right. Some brokers do have better intraday margin. All right. So this means if I buy 1,000 shares of a $100 stock, my margin is 1,000 times 100 times 0.5. So that ties up $50,000 in margin. All right. So think about that. If I buy 1,000 shares of a $100 stock, so Apple. If I buy 1,000 shares of Apple, it's around $100. I know it's more, but it's around $100. The margin on that 1,000 shares is 50 grand. That's a ton of capital. I know people that don't have that much in their trading account. So now option replacement. All right. In buying a heavy delta option, I can replicate the exposure of 1,000 shares of TLT stock using far less capital. All right. For instance, if I buy 13 of those TLT Jan 123 calls, I can get about 1,000 deltas. All right, that's share equivalents. I can get a correlation of the underlying of 1,000 of stock. But let's compare the cost. Remember that call is $3.30. All right, so let's look at TLT versus getting the same margin. So if I buy the stock for 125.77 times 1,000 times 0.5, that's 62 grand in margin. All right, if I buy those options, if I buy 13 of them, that's 330 times 100 times 13. That's assuming really non-marginable. Margin equals $4,290. Now there is downside to this, but think about that. Instead of 62 grand in margin, my margin's 4,300. That is a huge swing. So if my goal is to make $2 a day on swing trades, all right, I'm trying to make 2 grand. What is the return on 2 grand versus 62 grand, 2,000? All right, versus 2 grand on 5,300. I mean, it's not even close, right? One returns about 3%. One returns about 45%. Now there's downside. I'm gonna get to that. But you know, if I can spend 63,000 on something, or I can spend 4,300 on something, I'm gonna spend the 4,300, generally speaking. All right, so choosing the right option. For stock simulation, the 75 to 80 delta correlation option, that 75 to 80 delta, is typically going to track that stock well enough that one can use it in day trading or swing trading. It also should have enough liquidity, and this is important, that the trader can get in and out of it. All right. So if one is going long, one can buy calls. And if one is going short, one can buy puts. Or, and this is key, one can look at volatility. Volatility can add a second wrinkle to trading. All right. And you can see my YouTube video using volatility to trade for direction. If you look up, volatility and option pit, there is a lot of content on our YouTube page. We have tons and tons of content there. all right? But in short, and so that would be a next step of videos to watch, right? Maybe for our LVX series, that'll be our next one that we do, all right? If volatility is normal or low, buy calls or puts. But if volatility is really high, sell a deep put spread or a call spread. Sell an 80 delta put or an 80 delta call. Buy a 5 delta call or a 5 delta put as a hedge and to reduce margin. Short margining is more expensive than long margining, so you have to do it as a spread. All right, in the past, we've shown how short puts and covered calls can enhance the income of stock investors. All right, the issue is the margin associated with owning the stock shorting a put is still on Reg T margin. All right, and there's all sorts of different ways to do it. So now I'm going to talk about a very simple way to be a long-term investor using options cheaply. Replacing the stock, right? Rather than executing a covered call, one can execute a diagonal spread. All right, one can buy a long-term delta, a long-term option with a heavy delta. So that's a delta in the 50 to 70 range. Then sell an out-of-the-money option with a smaller delta in the nearer term generally at the 20 to 30 delta range. All right, so one can use monthly or weekly options. So you think about this. So you buy, like right now, if you say, boy, the market really stinks, but I think eventually things are going to go up. Well, what if instead of just buying stock and doing covered calls, what if I bought a long-term SPY call and sold a near-term out-of-the-money call against it? So here's a very simple example in Apple. All right. I could buy a Jan 1 10 call, and this is a little older, but imagine I buy a, this was an actual trade that we did. So this was the January 110s last year, and we can look at one for now in a second. All right. So imagine I buy a January 110 call for 450, and then I sell a regular DEIS at 75, and then I sell a regular DEIS 26 at 114, and I sell an Apple Jan 2 115 at 70. All right. So at expiration, as I'm unwinding the trade, the value of the 110 call is 365, and the value of the 115 call is 9 cents. So I made a bunch of money. So here's a couple that I've done on Track the Trade. All right, my show on SIBO TV. Yes. This was one that I did a while back last year, and I should do one of these soon. Maybe this will be my next show. I've been thinking about doing something for next week. So this was the trade this was trades we followed. Buy one Facebook 75 call for $2.51. Sell a Nove 28 call at 22. I covered it for $2.46. I sold a 77 call at the DEIS 5 at $1.32. I sold the 77 call at 80. I sold the 77.5 call at 130. I sold the 80 call at 80. And then I sold the 81 call at 42. And at the time, my 75 calls are worth $4.70, and my 81 calls worth 12 cents. So there's this progression of carrying the stock through. Yeah, that could be a really interesting one. So why don't we take a look at what we might do in Facebook now? Because, you know, I thought I must have accidentally closed my LVX terminal. All right. I have a lot of stuff open right now. All right, so let's look at Facebook with this pullback. And let's talk about how we might set one up. So first thing I'm going to look at is volatility. I'm going to pull up the LVX chart that will show me generally where volatility is. All right, so the top bar shows candles, and then the 50-day and the 100-day moving and the 200-day moving average. You can also get some other cool stuff if I pull up the stats bar. So let me just pull up the stats bar real fast. And there's all sorts of trading stuff that a lot of people don't get access to that we'll look at. So, you know, the big one almost all the traders I know look at is VWAP, which is volume weighted average price. Stocks tend to find that VWAP. But then some other things, you know, I like to look at the 52-week high and low price and IV. So we know that the implied volatility can go lower, but it can also go a lot higher, and we know that we're not that far from earnings. And we know that HV is high. So right now, implied volatility is in the 36th percentile, and realized volatility is in the 83rd percentile. So the stock's moving, and the implied volatility is relatively low. Then let me just see when the next earnings is. And I can pull up the LivevolX Super Earnings Analyzer. And the earnings were July 29th and October 28th last year. So if I buy November, I'm definitely getting an earnings cycle. So I would probably look at November. All right, and I'm going to filter down to just 2 at the money strikes and 2 plus 2. Actually, I can probably do 1. There you go. All right, so I'm going to go to November. All right, I'm going to buy. What if I bought a 90 calls? So I buy 10 of the 90 calls. All right, so 10 of the 90 calls is a 61. Those are 61 deltas. So that's the equivalent of 620 shares of stock, 610 shares of stock. The margin associated with owning 600 shares of Facebook for more than a day $28,000. The margin associated with these calls is 7. So I'm cutting my margin by 75%. So I buy those, and then I'm going to go to, I'm not going to sell in the next week. All right, I want something with a little juice. We're going to go for a little bit more. When I'm doing these, I typically want to get at least $1. So, and I never want to sell an option. When I'm selling options, I never want to be short at a level the stock was at the day before. So yesterday, Facebook closed where? Around $95, 95.5. So I'm not going to sell an option that is below 95.5. So I'm going to go to the October 9 strike. The October 9s. And I'm going to sell 10 Facebook calls. And this is what my position looks like. All right, and what I'm hoping is Facebook gets back to 95 and doesn't blow to 100. Now, the good news is, worst case scenario, if it does blow to 100, I'm fine. I mean, so this would be in lieu of buying the stock. So if I bought 1,000 shares of the underlying, now let's look at my 3D risk. And here's this part that should scare you. Look how much I can lose down 25%. Because I'm long calls, my floor is actually capped. Most I'm going to lose is less than 6,000 bucks. The question is, I bought a NOV 90 call and sold an OCT 90 call. No, I bought a NOV 90 call and sold an OCT 96 call. So I will pull up the order ticket for everybody to look at. Even though I am not recommending this as a trade. I mean, the markets are closed. We're aware of that, correct? But this is what the trade looks like. So the most I could possibly lose is 5,800 bucks. All right. Whereas I could take a bloodbath owning the stock if this ends up being a 2008, which I don't think it is, but who knows? All right, do we all understand that piece of stock replacement? All right, good. Actually, one of the cool things that LivevolX has is this really cool covered call scanner, but that is for a different webinar. All right, so now when to execute these? When is the best time to do? All right, this is a great strategy in just about any environment, but it's much better when IV is higher in the front month and long-term volatility is low. So the one reason why I like that spread, all right, when do you think I'm going to be? Do you think I'm going to carry that Facebook diagonal through earnings? Why did I only go out to no? Because I wanted something longer term, but not something that was going to cost 50 bucks. By November, my opinion should have taken care of itself. I mean, the November 20s are 3 months away, right? 2 months away? 2 months away. All right. So now here's the other thing. Let's say Facebook's still around 93 bucks in a couple of weeks. What do you think I'm going to do? I'm going to roll back. When doing these strategies, I always cover when my short option gets to be below a dime. And I roll back. All right, now, one must be watchable of a vol distortion in a month. So the key is, so you see these, one of the things I was looking at in Facebook was volatility. Now, Facebook has earnings on the 28th, and I can see that October is more expensive than November. That is good. Now, these front months are not quite as high as November, but they don't have earnings. So I'm willing to accept that. All right, other conditions. All right, it can be great to buy an earnings month or week. So one thing I love doing is using the earnings as an anchor, because that is what I mean by rollback. All right, I will briefly show this. So I'm short the October 9 calls, right? The October 96 calls. Let's look at their price this week. They're now 20 cents. So if I'd been short the September 25 96 calls, I would have covered them for 20 cents and rolled back to the October 9s and sold those at 10 cents, or at 110. Then when those get to be 10 cents or 20 cents, I might roll them back to the October 23s and try and get another $1.10. And then I would unwind them the week of earnings. All right. So it can be great to buy an earnings anchor. So I like to buy months where I know there's an earnings in front of it, because that volatility tends to really anchor, and stocks tend to rally into earnings. They do. Whether they're expected to be bad or good, stocks generally rally into earnings. So I like to sell front or weekly options in front of my earnings anchor. All right. Should be executed when one expects the stock to move slower. All right. In my previous examples, I was right in Apple and I was wrong in Facebook. Facebook really moved and I made money in both of them. All right. All right. VIX is a trading indicator. All right. We're going to talk about some indicators I use now. The S&P future is really the leader of the market. It leads SPY, the broad market indexes, and really just about everything. When ES weakens, so will most stocks, even if the stock is moving in the opposite direction of ES. So when the S&P 500 future starts heading down, stocks go with it. All right, so now, here's a question for you. Which came first, the chicken or the egg? In the scenario of volatility, movement, so actual movement or implied volatility, the majority of the time, option premiums, VIX futures, and VXX tick ahead of the S&P and SPY. So you can sit there and watch VXX or the VIX futures or LivevolX volatility indicator, and they will, generally speaking, especially in a choppy market, start moving before the underlying. So for those looking for entry and exit points, watch the vol and VIX futures and VXX along with ES and SPY. So if you are a vol, anybody here a futures trader, an equity futures trader, or a SPY day trader, or a SPY swing trader? If you're not looking at VXX and VIX, you are putting yourself at a disadvantage. They start to move first often. They can be a great indicator. If you've got a system that works, they can be a great confirming indicator. So I'm just going to show you I pulled this from today. And what I want you to notice is how choppy SPY was here. This is a tick chart. And I also want you to know how October vol premium, even as the underlying is kind of ticking higher, is creeping itself higher. All right. And then there was kind of a little mini one here, that led to this kind of drop. But sometimes they can be quite dramatic. All right. You'll notice that, volatility started to rally here, right? Oop. Volatility started to rally here, even as the underlying was still kind of up. And then obviously we tanked. It's not always, some days aren't as easy as others. Today was a really busy day, so there was a ton of noise. But especially in slower markets, now's not the perfect example, but in a slower market, VXX and volatility will lead. So it's not when they slow down, it's if the underlying is choppy and VIX is rallying or VXX is rallying, something's about to happen. Probably a move lower. All right, if the underlying is choppy and VXX starts to tank or VIX starts to tank, the market is probably going to make a quick move higher. You kind of see it here. Here's a little bit of choppy action. And then you see volatility start to drop. And then obviously it tanks. So this is one of the things I do. I've got a screen in LVX where I look at kind of tick charts. Not on this one because I'm on my laptop. But I look at these different tick charts and I'll just kind of watch how underlying volatility is moving. And if I want something smoother, maybe I'll look at November or December. But I generally don't like smoother. I want a little noise there because I can read through the noise. All right, so now multi-day patterns. This is one I've written up a bunch of times, is the break in correlation. And this is one I'm really looking for to find a bottom of the market. So one of the strongest multi-day signals, this is a swing trading signal, that VIX can send is a correlation break on a rally. Over multiple days, if SPX is up and VIX is flat to slightly down or even slightly up, that is bearish, super bearish. And we saw this in November. I mean, take a look at this. So number one is good. Number two, take a look. Market rallying. Underlying tanking or volatility tanking. So the red line represents VIX. The candles represent SPX. Look, vol dropping, underlying rally. Awesome. Now what about this one? Underlying rallying. Volatility, really stable. Underlying tanks, volatility pops. I would have considered some sort of long put up in here. Now here's another one. One of the strongest multi-day signals that, and this is actually stronger than the up move. All right. This is I think the strongest major market indicator using volatility. Well, the strongest multi-day signals that the VIX can send is a correlation break on a down move, and this is what I'm looking for an end of the rally. Over multiple days, if SPX is down and VIX is flat, slightly down or slightly up, that is even more bullish than that correlation break. All right, and this is one that we saw on Thanksgiving in 2011. I actually called the bottom in 11 on the blog. So you can see, here's one where the underlying is dropping, and the market's not doing much. Well, guess what happens? We pop. Then here we have another one where the underlying drops. Volatility stays stable. We went off to the races. All right. This is the pattern I'm looking for. I am looking for, and when I see it, I'll put it out there. What I'm looking for is multiple days of the S&P down in semi-ugly fashion, and the VIX going nowhere. All right. So those are my big SPX trades that I use for swing trading. Now here's one that I use. This is a scan that I use. And you can recreate it with a few stocks, but not all of them. You really need LVX. So this is one that I like to do. I like to find a stock that is at a 52-week high. And then I find a stock that it has an IV at a 52-week low. And then I buy a call that is 2% out of the money. And then I wait a week. I'm likely making a lot of money. So I've done this a few times, but I'll show you where these two scans are. I go to, usually my first scan that I look for is implied volatility scans, and I'll go to 52-week low IVs. Notice there aren't many today. These are probably all takeovers, that's why. All right. So, and then if I find one, so I'll look at Solera Holdings. I'll go look at a chart. And it is off to the races. Now, it can definitely go higher. In the 1 year, I think it's off to the races, and the applied volatility is in the toilet. Looks like they had earnings a while ago, so this is an interesting one. Are they a buyout target? It's got to be a corporate action, right? Yeah, all right, so they're getting bought out. So that's why it's doing that. So that's not a good trade, right? I've got to make sure that that's not the case. So clearly, when the VIX is at where it was earlier in the year and where it is now, you're not going to find a lot of 52-week lows. So I'll pull you one that we did in the strategy letter using this approach. This is ULTA. We used it 3 different times and made money every time. All right. Every time this stock hits a 52-week low, and the stock is right near a 52-week high. So what I'll typically do is probably wait a day. So stocks at a 52-week high, options at a 52-week low. I wait a day. They typically will let it off a little bit, and then I buy an out-of-the-money call right around the 2% out of the money. that has been a great technique for swing trading calls. So here's my other scan that I use. So I find a stock that's at a 52-week low. Then I check the 52-week high IV. If the stock is not at that 52-week high IV and it's at a low for a year, it's likely to keep going lower. So now here's what I did find, Macy's. Macy's is at a 52-week low price right now, $53. All right, now, if I pull up the chart of it, let's take a look at the chart. Now, one can obviously tell that I'm going to throw out kind of the flash crash and even our little pop here, but take a look, like volatility is now not as high as it was on Macy's last earnings. Now we've got a lot of beta in the market. There's not as much alpha, so the S&P 500 is driving things around. But as I look at Macy's, this is a name that I think could go lower significantly. 2% out of the money is of the stock price. That is correct. So as I look at Macy's, all right, so I'll pull up Macy's. I'm going to show you how I might develop a spread real fast. So I might look at the skew chart. I'm going to try and find the volatility with the lowest. So I'm going to go to the October, probably going to use the October regulars. And I'm going to look and see if there's any kinks or areas where things are especially cheap. And what I notice is that the 51.5 puts are expensive and the 53 puts are cheap. So what I might do in October is I might actually buy the at the money put, sell the 51.5s, create a put spread. And then you can see I end up with a really nice risk reward for something that is right at the money. You know, I'm risking $500 to make 1,000 basically. That is an inexpensive spread on a stock that could definitely go lower. You know, I'm not a technician on any level. So, I mean, if I pull up a longer term chart, I'll let you guys tell me where this thing could go. Yeah, right around, 50, 51-ish. I can see 51. That's a great spread. I may do that. I may do that tomorrow. Obviously, tomorrow is a new day. So in summary, use in-the-money options to stimulate stocks. Use indicators and diagonals to stimulate a covered call. Use calendars and diagonals to stimulate a covered call. Use vol as an indicator. So now, sign up for a free 15-day trial of LivevolX for Options platform. Now, you can, if you like LivevolX, they do execution services. My clients get special pricing, all right? Or if you like LivevolX as a platform, but or as an analytics tool, but you want to use your brokerage platform, you can buy LivevolX as a platform to learn to just do analysis. It's up to you. So sign up today, and you can get this free trial. And if you don't have the offer, all right, I put the offer in chat for the free trial. And if you've got questions on it, feel free to email me, mark@optionpit.com. I am an expert with the product, as you can probably tell. All right, questions, comments, thoughts, raves. Feel free to tell me how great I am. If you hated it, please don't. All right, any questions? All right, I don't see a lot of questions. Did we enjoy hopefully we enjoyed the webinar. All right, how do you choose the best call spreads? Emma, the person that asked that is in and of itself an extremely long webinar. Where do you get YouTube recordings? So if you want to see my YouTube recordings, I will go to youtube.com and just search for Option Pit. And there you go. There's our room. You can see everything you want. Volatility is still high since August 24, but decreasing. What do you see as a SPY trade? You know, I think SPY is going to retest the lows. You know, we had that weird flash crash. I would like to see us get to the lows and not break the highs of August 21st. And that will be a very confirming signal. Well, hopefully not too much, Joe. And if it did, some of it went over your head. You know, there's all sorts of educational content on our YouTube page that you can pull stuff, or you can read my blog. Well, no, I mean, you know what? Understanding what you don't know is super important, and I really appreciate that. So, knowing what you don't know is a great place to be. I'm really glad that you guys enjoyed it. You guys can email me, mark@optionpit.com, if you have questions. You can call me, 888-888-TRADE01. Thank you very much, guys. I hope everybody has a great night. I'll have this emailed out tomorrow.